Here's the problem. Most of us think that we are already doing all we can to minimize our taxes, to legally and ethically take advantage of the tax code and pay no more than we need to. But the U.S. tax code is very complex and very confusing, so taking advantage of all its provisions is more than a little complicated, especially when it comes to understanding the long-term implications and trade-offs between tax deduction, tax deferral, and tax exemption. However, not taking advantage of all the tax code provisions can reduce both the value of your capital assets and the income those assets can produce for you by hundreds of thousands of dollars, especially over 20 or 30 years of retirement. So, how can you be sure that you are taking maximum advantage of what the tax code allows? With the Safe Money Lifetime Tax Strategy. That's how. Now, this is not tax advice or tax preparation. This is a comprehensive lifetime tax strategy comprised of multiple solutions and a combination of financial instruments, including legal trusts, insured contracts, and employment agreements, as well as transfer exemptions, leveraged financing, and interest deductions, all based on several standard provisions of the U.S. tax code. And none of it requires any change to your current monthly budget, nor any questionable or dubious interpretations of the tax code. It's all done by simply rearranging the way you own and the way you use your capital assets, including your earned income and your home equity, or your business revenue and your business equity. Now, any one of these techniques can save you money, but the right combination of several techniques, properly coordinated, can save you hundreds of thousands of dollars. For example, Steve and Terry were in their mid-50s. They had $260,000 in their IRAs and a home valued at $510,000. They also had Steve's pension that would pay them $4,200 a month for as long as they both live, and they were saving 10% of their incomes every month. So they assumed that there was nothing more they could do to safely increase their retirement income or legally decrease their tax obligations. But by restructuring what they already owned and redirecting what they were already saving, they were able to create an additional $64,000 of tax-free retirement income every year for as long as they live. They were also able to make tax-free provisions for nursing home or assisted living care if either one of them should ever need it. What's more, they will now pass $1,700,000 to their children and another $200,000 to their church, all of it tax-free. Using the Safe Money Lifetime Tax Strategy, they are now projected to save more than $390,000 in taxes based on current tax rates and scheduled to gain at least $1,640,000 of retirement income based on their life expectancies. But Steve and Terry are not an unusual example. In fact, they are quite typical, because the Safe Money Lifetime Tax Strategy has been proven to work for hundreds of people who thought they were already doing all they could to legally minimize their taxes by taking maximum advantage of the tax code. The Supreme Court has stated that the legal right of an individual to decrease the amount of what would otherwise be his taxes, or altogether avoid them, by means which the law permits, cannot be doubted. So, ask yourself this: does it make good sense to assume that you too are already doing all you can to minimize your taxes by legally and ethically taking maximum advantage of the tax code? Or does it make better sense to talk with a Safe Money tax strategy professional who can help you choose the right combination of legal and financial instruments to construct your own lifetime tax strategy?